Hello and welcome to this BIA webinar. Biotech Venture Capital Funding is all venture money created equal. I'm Martin Turner. I'm Policy Manager at the BIA responsible for finance policy. Before I introduce our panel members today, I have a few housekeeping things. So you're all on mute, so you won't be able to be heard if you start asking questions, but you can ask questions via the little text box, and we will see them pop up here in our office, and we'll read them out as we go along through the webinar. This is also being recorded, and we'll be uploading it onto the BIA YouTube channel after the show. So, welcome everyone. We have Ash Patel from Mercia with us, Claire Turlow from Syncona, Genghis Lloyd Harris from Abingworth, and Jeremy Kernock-Cook from Bioscience Managers. Welcome everyone. Thank you for joining us. If I could perhaps start with you, Ash, would you be able to introduce yourself and tell us a little bit about Mercia Technologies, please?
Great, thank you. Thanks, guys, for having me here today. So my name is Ash Patel. I'm Head of Research and one of the lead healthcare investors for Mercia Technologies. We're an AIM-listed investment business focusing on UK technology companies. Healthcare and life sciences comprises about a third of our portfolio, which currently stands as a whole portfolio of about £500 million in net assets. As an investment house, we like to do early stage tech investing. So anything from a seed stage investment through to Series A, Series B. We offer a differentiated model by having investment teams all around the UK, particularly working closely with universities and university spin-outs to help commercialize some of the IP that's found outside of the Golden Triangle. My own background, I'm a physician by training. I spent a number of years as Director of Technology at Babylon Health, and I've been with Mercia for about 2.5 years looking after our healthcare investments.
Thank you. Claire, tell us a little bit about Syncona and your background, please.
So I'm Claire Turlow, I'm Head of Corporate Development at Syncona. Syncona is a FTSE 250 listed company. Market cap today is around 1.7 billion. Syncona's model is to found, build and fund global life science companies. We're focused on dramatic efficacy in areas of unmet need, and we're established leaders of cell and gene therapy.
Thank you, Claire. Genghis,
yeah,
Abingworth.
Hello, Martin. So Abingworth has been around for 45 years, and for the last 30 years we've been a pure play life sciences investor. We're headquartered here in London, but we've got offices in Menlo Park and Boston. We'll do anything from a gleam in a professor's eye all the way through to phase 3. And we'll look at all therapeutic areas except Alzheimer's, which we put in the box. We are quite open to different modalities, but we no longer do diagnostics or devices because we found those areas too challenging. All our home runs come from biopharma, and all our problem children were in diagnostics and devices. I myself has been at Abingworth for about 15 years and formerly spent 15 years at CSFB in healthcare investment banking, and originally was a physician too.
Thank you for joining us. And last but not least, Jeremy Kernock-Cook, tell us about Bioscience Managers.
Martin, thank you for the invitation. I have been around in the sector, I suppose, for the last 45 years, so mirroring the Abingworth lifespan. Firstly as an entrepreneur, and then joining Rothschilds in the mid-80s to run the bioscience unit there. And then more recently as Bioscience Managers, which is now 17 years old or thereabouts, we built a multi-fund business which seeks to play internationally, but has 3 principal locations, which are London, the US, which is actually Houston, and Melbourne, Australia, where most of us are housed. We like to invest in what we call healthcare technology, which excludes bricks and mortar, but includes just about anything else. We like geography because we like to travel. We like to look at mid-stage companies, which is where somebody else has paid for the science, and we're looking to see whether the science is actually clinically relevant. And that way we think we can add value.
Thank you. So as you can see, there's a real range of VC investors in the life sciences sector, and we have possibly a small subsection of them with us today. So it's hopefully going to be a very interesting discussion, talking to each investor and how they're different from each other and how they take a different approach to their investments. So with such a range of different types of models out there, Genghis, how do you think companies should start identifying the right investor for them?
Well, the first thing is it's never too early. So the four of us on this call, for example, we all do early stage investors. We're good people to get to know. And I think it's a question of networking, going to the presentations, hearing what VCs have to say, and knocking on the door if you have an introduction. It's always better to come to us through an introduction than just come cold off the street. We do, of course, look at everything that comes over the transom, but it's going to get more attention if it's an introduction through a friend. But I think we certainly at Abingworth, and I'm sure the others would say the same, have got lots of connections in academia. So one way to come to us is through those academic connections.
And Claire, Syncona is another one that you very much pick up IP at its very earliest stage. So do you get many investors coming to you, or are you going out and finding the IP to develop?
So the approach is very proactive, but we're focused on exceptional science. So we're more interested in finding science that maybe an academic or working on that might be of interest to us. So we don't often have sort of fully formed companies, if you will, with a big syndicate of investors coming in, because we're very much looking at businesses that we can found ourselves and that we think fit our model, which is to build those companies to a point where we can have meaningful stakes in those businesses when those products come to market. So that's very much how you should think about Syncona's approach, which is if it fits the model that we talk about, and you can read about that in our results and on our website, etc., or you want to give us a ring and talk to us about it, please do. But we're definitely looking for meaningful stakes in companies that have the ability to take their own products to market.
Mm. And Jeremy, how do most companies first come into contact with bioscience managers?
From our standpoint, the ideal is that they actually go onto the website and find out what we do. It's worth looking at our portfolio because that's a good indicator of what we have done. It's worth looking at the funds that we have under management because they all have different nuances to them. So in the UK, our primary funds are venture capital trust based, and therefore question one is, am I venture capital trust eligible? Because if the answer to that is no, then I suggest that you move on to Abingworth because that's going to be a better source for money. So the exercise, frankly, is try to understand how each of us operate, and we all do it slightly differently. We take pride in doing things on an international platform. Something can start here, but we might have it end up in the US. It could start in Australia, and it might end up in the UK. Those are all important aspects of the way in which we think we can provide most value for the individual companies.
And Ash, do you find most companies come to you through your website first, or is it very much a networking type approach?
So much like everyone else, we will of course look at everyone who applies through our website and give it a fair hearing. That said, I think it's a bit of a truism that warm introductions tend to get warm responses and are more likely to engage with the investor if it's coming from somebody who we know and trust. So what I often recommend to people if they don't know Mercia or don't know anyone in investing is to look at the portfolio companies and speak to them about the experience of working with Mercia and get a feel from essentially our customer, who is the portfolio company, what their experience was like and whether they enjoyed working with us and whether you might enjoy working with us as well.
Thank you. Claire, in a former life that wasn't too long ago, you were at Numis as a broker. What would be your advice from that experience?
In terms of companies looking to raise money? Or,
in identifying the right investors and looking to raise money.
Yeah, so my former experience was with listed companies in London in the life sciences space, but obviously it's, the views are applicable across private companies as well. And Genghis has also 15 years of investment banking experience and should add to this. But there's not a real difference in terms of how you should approach thinking about raising money either through a broker or direct. I mean, the sort of general principles are that you should have a very short slide deck of messages that make sense, that have been sort of well thought out, that anyone can understand, even though we're all specialist investors. Make it easy for people to understand, have a good commercial strategy, and be clear about what you're trying to build, and to know who it is that you're going to approach, because every investor is looking for something slightly different. And quite often, you can find people showing up to a meeting with a slide pack that they prepared, and they're absolutely diligently plowing through every single slide, and they're not reading the room, they're not reading the body language, they're not assuming a general level of knowledge that might vary from investor
That's
to
so right.
investor.
Can I just come in on this?
Yeah.
We advocate the 10-20-30 rule. 10 slides, 20 minutes, and no font smaller than size 30.
That's brilliant. Yeah. Yeah. I mean, I do think that's one of the biggest issues with raising money, is that actually at the end of the day, no matter how much domain knowledge people have, if you can't sell your business in 10 slides, it's pretty hard to get that level of interest. And nothing annoys brokers or investors than a management team who show up and haven't done the homework to enable them to have a specific discussion that's relevant to the person in the room.
One of the obvious comments is to pick up on is that we invest in people. And so sending the wrong person along to make a presentation is not exactly the brightest thing you can do. Ultimately, we need to see the best salesperson, the person who is most able to capture the excitement that whatever the enterprise is all about is going to turn us on from being skeptical to being positive. So at the end of the day, it is all about people, and remember that and prep beforehand, because you only get one shot at this, and you better make sure it's well worth taking.
Mm-hmm. So a company has come in, it's done a great pitch to you, and you've chosen to invest. What's your next step for creating the relationship with the company and managing that relationship as you progress through the investment?
Well, it sounds like you're setting the scene for going into due diligence, and that of course brings you closer to the management because you spend time with the science. Depending on where they are, they may have some manufacturing plans. You need to spend time with the IP. So there's diligence brings you a lot closer, and that's probably the next step in building a close relationship, I think.
I think one of picking up on that point, we've all been around this for long enough to know that we make mistakes. What one learns from the mistakes is that the due diligence really does have to be done to a significant degree of detail, because if you don't do it, that's where you get caught out. And so while the experience with the venture investors is long and arduous, it's long and arduous for very good reason. We only want to pick the right companies, and we want to make sure that we have actually looked under the carpet and checked the drains with as much care as we can. At the end of the day, that's what we're paid to do, and that's exactly what we will do.
Claire, do you, as Syncona, presumably, if you identify some IP in a university, the best science, as you said earlier, how do you work with the academic, and does Syncona always take a seat on the board of the company?
Yeah, so that process actually is a long process. So it starts with identifying that exceptional science. And then the team at Syncona spend a long time really diligencing that science and trying to understand whether, in fact, it is something that you can build and construct a company on the back of, and whether and digging around also on the sort of commercial and business strategy for that science, because our model is that we have a smaller number of investments, but I mean, at the moment, there's 9 companies in our portfolio. 8 of those companies were founded by Syncona. So it's a different way of building companies. And currently, we have 15 board seats across those 9 companies. So we're very, very heavily involved with trying to get that all positioned from the beginning before the first pound goes into that business.
And Ash, does Mercia take the same approach? Do you always take a seat on the board?
Yeah, it's most typical for us to take a board seat. And actually, I think the conversation and the relationship building, particularly with academic scientists, who are often the originators of the IP that our businesses are built around, actually starts with a really simple conversation on what they want out of all of this. It's very easy for commercial people to make an assumption that people want their careers to go one way or the other. And actually, when you speak to the founding scientists, many of them want to maintain their academic commitments to their university. Many of them want to have external research interests. And one of the things which I like to do is map out, well, what does this person want? How involved do they want to be? And therefore, what sort of team do we need to help them to build around their idea?
Genghis, what's your best or worst example of a relation, something that CEO has done in one of your companies that's perhaps led to a particularly good relationship, or perhaps something that didn't go quite so smoothly?
Well, the good ones and people who've done well and made money for us, very often we'll back them in a second company and a third company. So, for example, Edwin Moses, we backed him in Ablinks. He's about to become chairman of another company, but I can't say too much about that at the moment. We backed some like Pat Mahaffey. We invested in him in Farmion and then again in Clovis. And so on. So that's a very good way of going about it. The bad ones, that's very difficult to talk about in this forum, but we do, we have pushed CEOs out who have not been performing well. And it's always difficult. There's always nervousness among the syndicate. Oh gosh, what will happen? But in fact, when you replace a poorly performing CEO, it's usually good for morale and good for the company. But I'm not going to name any names.
I think if one starts with the recognition that the relationship is going to have to last a long time, from the moment we write that first check to the moment we've managed to exit, we're going to have ridden through lots of different challenges, lots of different bumps in the road. So the relationship that we strike up at the beginning needs to have that in mind. It is also sensible to be honest about that relationship and to explain, as Genghis was touching on, that he who starts it may not be there halfway through, may not be there at the end, for very good reasons to do with background, with interest, with the elements that are necessary to make the enterprise successful. So if that conversation is had up front, then nobody gets to be surprised when it comes to move on time. And one tries to do the move on in a sensitive way that doesn't necessarily mean somebody has to leave the company, but does mean that there's going to be significant evolution, both within the management and also key issue within the board.
So I think that's spot on. There are some CEOs who know that they're not the right person to take us all the way through, and you have that conversation, it works well. There are some other CEOs who think they're doing a wonderful job, but the rest of the board doesn't. And that's where it gets traumatic, because if they perceive themselves doing well, it comes as a shock. Yes. We turn around and say, well, actually, we don't think you are.
Yeah.
Hopefully, we don't get many of those.
And if a company has been with you for a while and it needs to raise more money, and it's not an exit, it's follow-on money, and perhaps if it needs to bring in new investors, what should the management of that company be thinking? How do you like them to approach that challenge?
Well, we like them to take responsibility for that challenge for a start. So they're not just looking at us and expecting the next check to be written in some automatic form. You actually made me think about a company of ours where we literally got an FDA approval for its product about 2 months ago. And that's probably the first time that I can remember in the last 10 years of actually getting all the way to approval. Normally one ends up getting halfway there and one's taken out or pass it on to somebody else, or we as the fund exit. But there we were all the way through to FDA approval. And suddenly we're faced with a situation that we've now got to put a sales and marketing team together. So there's a 40 million bill required that needs to be covered. That normally would have frightened the pants off us, but on the basis that we've lived this thing all the way through to that great moment. So we, the company, and some significant other players who are new to the company all got together and have now produced the 40 million, and we're all on track. But it just reminds one that this is a collective, a teamwork exercise that needs to be maintained at all times. This is not any one way of doing it or any one person who's going to be instrumental. we've got to hold this together as an exercise.
And it can turn out on unexpected paths. So, for example, we invested in Gamma Delta Therapeutics, which was just a gleam in a professor's eye spin out from King's College. And we put £800,000 in and started going, and then we wanted to syndicate it. So we were going out to talk to other VCs, which is the normal thing you would do. But then along came Takeda and made us an offer we couldn't refuse, and $100 million went into the company, and they have an option to acquire the company at a pre-agreed price at any time over the next 4 years. So that went from suddenly being the plain vanilla VC syndicate to being, in effect, a build to buy. But either way, you're building relationships with the people who are going to finance and develop the company.
And Claire, a number of Syncona's portfolio have IPO'd now. What, how does Syncona feel about IPOing and the destination for that? And then perhaps we could open that up to the other panels members.
Yeah, sure. I mean, I would say though, just touching on picking up from the last point, that actually because the model is slightly different at Syncona, and we expect and we want to be able to fund meaningful Series A, Series B investments. We may not necessarily want to be having those conversations where you're talking about syndicating rounds, and we have a model which we think enables us to fund those businesses for longer ourselves, and to retain those meaningful stakes in those businesses. So there's a slight difference in the model there. And for the two companies that have IPO'd on NASDAQ, for us, those were very much financing events. So we don't see an IPO of one of our companies as an exit. We look at them as financing, and we want to make sure that we are doing that at the right time, and that we can, if we want to, that we can participate in those events as well. So in terms of the listing venue, I think when you're talking about companies specifically in cell therapy or gene therapy, then if you compare the peer group for those companies, London versus New York, then it's kind of obvious where the analyst coverage is and where the very, very specialist investors in those types of therapies are. And it's important when you have assets that are in those sectors that they can be seen on a global platform, because we build businesses to compete globally, and so that's sort of the logical place that they would go to.
And Ash, what's Mercia's exit strategy? Do you have a similar approach, or do you take a different one?
So similarly, we would seek to keep our positions in businesses for as long as we can. We try to target a meaningful stake for as long as possible. Exit-wise, an IPO event is most typically still a fundraising event, and we wouldn't expect to unwind a position simply because it's IPO'd. In fact, our most successful investment to date, the majority of the returns were actually built up on the public market once the business had listed, but we held into our position, and that was where Blue Prism, which is a software business, we were able to turn a relatively small seed investment into a significant return. So yes, IPOs are useful, but no, they're not necessarily an exit. Trade sales, and we've done a number of those in the last couple of years, are generally speaking where we aim to seek our cash returns over a short-term period. And then in terms of what the company needs, I mean, the thing to be mindful of is we're only ever minority shareholders in these businesses. And so there is still a business with employees, a product, a founder that needs to go on and have a life of its own. And so we very much view the exit process for us as still being part of the company's journey, and making sure that the product and the technology goes to a good home is a very important part of that.
I suppose just picking up on the comment that public markets are primarily a funding exercise as opposed to the exit. We've looked at using markets in various different jurisdictions. I think in a recent fund, we made 7 investments. We used 5 different public markets for 6 of those. The reason for doing that is we went where the money was. Very simple. We also have to remember that each of those 5 operates on a completely different set of rules. You think it's the same, but it isn't. And you need to understand that it isn't, because otherwise you find yourself being chased around by regulators. So again, remember when you, the company, are planning something like this, ensure that you've got the right advisors, ensure that you've got the venture backers who have been there before and are able to show you the right way of approaching this exercise of fundraising.
Genghis, is Abingworth able to follow on to the public markets in an IPO event?
Absolutely, and an IPO is a stepping stone to an exit. It's not an exit, and in fact, we usually have to invest in the IPO to support the deal. But over time, you can sell stock if the company performs well. And what you would typically do is take some money off the table, but hold on some for the long term as well. And obviously, long horizons tend to give bigger rewards. And I agree with Jeremy. There's different markets that have different characteristics, particularly in Europe. Sometimes companies have options to float on more than one market. If I go back to the Galapagos IPO, it's a few years ago now, but Peel Hunt was looking at taking them public in the UK, but Peel Hunt had been acquired by KBC, and when the guys in Brussels got to hear that a Belgian-Dutch company was going to list in the UK, they said none of that, and so they took it public in Europe, and it broke a 5-year drought of Euronext biotech IPOs. And I think generalizations are dangerous, but in general, if a UK company or a European company is really strong, they prefer to go and IPO on NASDAQ, as for example, auto-listed one of the Syncona companies. And we've had this 6-year bull market, 270 companies have gone public on NASDAQ, and that's the place to go if you're big enough and exciting enough that you can do it.
And the BIA's data on UK biotech companies fundraising has been particularly impressive this year with, well, up to September when we last published our data, there was £900 million in venture capital raised, which is far exceeding the 515 in 2017. What do you think the reasons for that are? I mean, is there more money coming from the Far East or from America?
I think across the board, we've seen venture funds raise, more money has come into venture capital. That's part of the response to what people have seen in terms of IPOs and M&A exits. So there is definitely more capital available. With more capital being available, it's changed some of the parameters. So, for example, if I look just at the US statistics where the numbers are more readily available, over the last 3 years, the average size of a Series A round has doubled, and the average valuation of a Series A round has doubled. But we're seeing that over in Europe too. I will say that in the UK and in continental Europe, in general, valuations are lower, and you can find a comparable company at a lower valuation. But not always, because sometimes the UK companies say, well, look, this is what our US peers are getting, and we want the same. So I think there has been inflation in valuation, particularly in UK private companies, that spilled over from the US.
Jeremy, you said you take a very international approach to your investments. Do you agree with that analysis from Genghis?
I do. I mean, it worries me sometimes when suddenly has this flood of money that comes running into the market, and then disconnects arise between geographies and valuations and the amounts of money that can be raised. One point I would make about the UK is that we have been guilty for many years of semi-starving the companies that seek to get funds raised here, and that puts us in a very difficult position vis-a-vis the comparable companies in the US. Those differences show through more and more the longer the adventure runs for, and that's one of the reasons why I think we still are dealing with a sector which has yet to truly capture the investing public's imagination. That includes the institutional investors, because we're not allowing the businesses to grow at a pace which they could do if they were funded sufficiently to make the steps necessary for those sort of value-adding milestones to be passed.
Yeah, there's a euphemism for that approach, drip feeding, and I agree, it undermines companies.
Claire, from Syncona's point of view, I mean, you, as you said, you want to back these companies throughout the process, throughout their growth, and I think you don't certainly you couldn't be accused of taking a drip feeding approach to building these companies. Do you see that as an approach that could be replicated in more venture capital firms?
Well, I think that's a question for everybody, really. But no, I mean, I think it's good that there's different approaches. There's probably no one right approach, and there's an ecosystem that has to be there for funding the whole sector. You can't just rely on one model or one pool of capital or one approach. I wouldn't think that anyone is going to sit here and say that they've absolutely nailed the approach. It's just that our approach is different for the reasons that I've set out, based upon the belief that actually the out return in life sciences is greatest at the point that the company has a product that's been approved. And so we want to hold meaningful positions in companies at that point. And there's a very specific type of company and a type of sector or subsector that fits that model. So if you don't look like that and you're developing different drugs or different technologies, then a different model would suit that. And there's, outside of the sort of the private VC world, there's lots of investment banks in London that have private placement teams that work with capital from all over the world, from Asia, from the Middle East. And Asian investors are, looking to invest more and more in the UK. So, my personal view is that, that you have to, as a company listening to this webcast, just get out, like Angus said, get out there and talk to people, find the right people that fit the kind of company that you want to build, the kind of science that you're backing, because it's not going to be the same for every person.
Yeah. You have around this table 4 VCs with very different models, but at heart we're all traditional VCs. In contrast, say, to the high net worth or angel investors. And just a word of caution there, because sometimes as an early stage company, it's very tempting to go to the high net worth individuals or the angels. But I would say that when you go to venture capital, you get a certain professionalism that you might not get from some other financial sources. And we'll make sure things get done properly, because we've been doing this for decades and decades, and we know what needs to be done to build a successful biotech company. So although high net worth money can be tempting, we encourage people to look at VCs, and as you say, there's lots of different types of VCs.
Yes, and Ash, you've got a focus outside the southeast. You said at the beginning. How does it look for companies outside of the southeast for fundraising at the moment? Do you think they've got it as good as the companies that are based around London?
No. The data clearly shows that London continues to attract something like 80 to 90% of all the venture capital money in the UK, but doesn't have 80 to 90% of all the companies. So there's that has 2 effects. Firstly, I suspect a degree of valuation inflation in and around London and the southeast, and part of our core investment thesis is that we can find comparable companies at a more sensible prices elsewhere. The second thing is that there ends up being a drought of money outside of London and the southeast. And that's one of the things that we're trying to rectify with our investment model. That said, I'd echo what Genghis was saying earlier regarding the use of angel and high net worth money. It is very easy to take tax incentivized money from high net worth individuals who are essentially insensitive to the valuation of your business. And you can raise a seed round and even a meaningful Series A round doing that with big enough syndicates. The challenge will then lie when you want to access Series B type financing and you have a shareholder expectation of value inflation, which is out of keeping with what your business is actually capable of delivering. And so I would advocate taking a sober view from a VC from time to time, if only just to sense check where you're at and think not about the round that you're filling now, but actually the round that's going to come after this. And is your company going to be able to grow into that space and achieve milestones that justify a higher valuation than the one which you're asking for today?
Jeremy, you back VCT eligible companies.
Yeah.
So that's another tax incentive to get individuals to put their money into innovative companies. Does that have any ramifications for future fundraisings as well?
It does. Well, I suppose I should differentiate here between the high net worth individuals who come into a venture capital trust who have no say in how that money is then deployed. So that's in the hands of the manager. And great uncle Arthur, who gave 100,000 to his nephew, and then put on some restrictive terms, which made it incredibly difficult for the nephew to do anything other than give up. I mean, those are the sorts of things that, as Genghis was referring to, we spend our time unraveling if it's worth it, or generally leaving alone because frankly it isn't worth it to spend time fighting great uncle Arthur, let alone everything else that goes with that. The venture capital trusts, I think, work well in certain specific areas. One has to recognize that there are rules that they have to work within, and those rules are not exactly friendly in the life science space because life science and healthcare technology development takes a long time. And one therefore needs the money to be patient money, committed money, and can be added to money over that period to get to a point where there is a genuine demonstration of value. So I see the VCTs as having a role to play. It's great that they have they're able to raise the funds, but one has to, in effect, use them with caution because ultimately one does not need those rules to get in the way of the continuing financing of the enterprises that they're supporting.
Mm-hmm. Claire, you mentioned earlier money coming in from the East, and certainly I think the BIA is seeing this, and we have a lot of work ongoing trying to build stronger relationships between the UK and China, and particularly activity ongoing in Hong Kong, where the stock exchange has changed its rules to allow biotech companies to IPO. But that interest that the Chinese and others have in the great science that we have in the UK, do you think that's changing the shape of VC in the UK at all? Do you think it's changing how companies in the UK need to operate?
I mean, I can best answer this question with my previous hat on.
Yeah.
Because it's, it doesn't. I think from my experience, just working with in the equity capital markets as a banker, and then doing some private work there, definitely in the last 2 years there has been a massive increase in the number of Asian and the types of Asian investors looking to make investments. I think the experience that I've observed in my role at the time was that, first of all, these investors, from what I've observed, are very sophisticated, generally have incredibly detailed knowledge about the science and the companies that they're looking at. So they are also valuation sensitive, and I think there's a bit of a misperception or a perception out there that some of these investors aren't. And my experience is that is not at all the case, that sophisticated Asian investors are absolutely globally to a global standard in terms of what they're looking at. So I don't know if you've had a direct experience.
Completely agree, Claire. And they're coming to the UK because they think it's cheaper than the US, and they think valuations have got overheated in the US. We're also seeing Chinese investors coming into venture funds in the UK and Europe. And in fact, in our most recent fund, which we closed earlier this year, 3 of our limited partners are from Greater China.
So one of our funds actually is funded by investors from China. But a little bit like a VCT, the money comes in, it's in the box, and we're responsible for its allocation. And therefore, the Chinese element is only that they contributed the funds. But we therefore spend a fair amount of time in China, in Hong Kong, talking to other fund managers who have themselves raised money, or in fact, they might even be playing to their own money. And that's where culturally there are differences that appear, where those fund managers have different perceptions about what they want to see happen and the speed with which they expect success to come through. And those are things that one has to get properly balanced, and that actually requires conversation. Certainly if you're putting a syndicate together, it requires conversation between those who think something's going to happen very rapidly and we who probably take the more pragmatic view that would be lucky to see something positive within 5 years.
That's very good advice. So I think we're coming towards the end of our time here today. So I'd like to just go around the panel one last time to say, what's the one key piece of advice that you'd give to a company that is looking to raise money? And then perhaps a second, if you have a thought, in the next 5 years, what do you think is going to be the biggest change in UK biotech VC? Jeremy, I'm going to put you on the spot as the first person.
I will give the advice to those who have already got our money. And the advice is very simple: no surprises. The moment there's a surprise, that relationship is under stress.
You took the words right out of my mouth. I was going to say that. Trust is so important. Yeah.
Exactly.
Yeah.
In terms of where are we going over the next 5 years, I think there will be a greater recognition that this sector is one that merits the professional attention of professional fund managers whose expertise is not life science, but who can rely on the fund managers who are expert to place that money effectively within the industry. We want to see more of that. We want to see the funds coming in that can then be well managed. That, I think, is going to happen, but we need to continue to remember we've got to encourage that, and that's encouraging it through our performance, but also encourage it through helping those who are nervous to recognize this is not a visit to the casino.
And Ash, what would be your top tip?
I would say due diligence your investors as carefully as they due diligence you. I'm always amazed at the number of companies that are prepared to sell me a chunk of their company without asking me any questions about who I am, what my intentions are. And the analogy I use is, God forbid I can divorce my wife, but I can't get rid of my investors. So you are stuck with people whose money you take. So make sure you understand them properly and their motives properly. And on the question of what is going to be the big change in the next 5 years, I think we're going to see an increase in the number of European and particularly UK companies exiting via IPO events in Singapore and Hong Kong. Those exchanges are rapidly becoming where the biggest pools of capital are starting to aggregate. They are opening themselves to the kinds of businesses that biotech VCs are likely to build. And as someone said earlier, you always end up following where the money is. And that is certainly where the money in the world is aggregating at the moment.
So I think we should warn Ash that Mrs. Patel has signed up for this webcast.
She's heard me say that before. She's probably more likely to leave me than I her, I promise you that.
Claire?
Yeah, so in terms of tips, I would say, I mean, similar to what's been said, but, you know, it's all about the scientific data. So come prepared to be really, really clear and transparent about the data, and do it in a very forthright way, and develop a relationship, like Inga said, built on trust from the very beginning, and know that actually, we're all trying to help get to the right point together, and we have a very, a partnership model, which means that actually, it's all based on just being yourself and being honest and transparent with what you have and what you want to build. So as a starting point, you can't go wrong with that one. And then in terms of, changes ahead, I think when we look at the UK, specifically talking about the UK, what I'm hopeful about, and I think it will take time, but I really am hopeful that there will be a shift, as is being discussed, in terms of UK pensions allocations. And that will take time to come. But if we can get that right for UK companies raising money here with domestic capital, then a shift in the ability of pension funds to look across their asset allocation and be able to allocate specifically to life sciences or technology or innovation technology, whatever you want to call it, that's going to make a big difference to companies in the UK. So that's what I would like to see.
I'm glad you mentioned that. So it's something the BIA is looking very hard at. And over to you, Genghis, as the
Yes, well, I think the first point on advice has been very well covered by Jeremy and Claire, and no point in reiterating. Well, it's always worth reiterating trust because it's so important. But if I was going to give an alternative piece of advice, since we've covered that, I would say patience is tremendously important too. And one of my favorite quotations comes from George Rathman, the first CEO of Amgen, who said that he had never seen a worthwhile project that hadn't walked through the valley of death at least once. And in terms of the next 5 years in the UK, it's going to become more international. And we're already seeing US VCs coming over here. F-Prime have a well-established presence here. 1 or 2 other VCs are actively looking at setting up offices in the UK. We're seeing that the money is coming from China. We are seeing some Chinese VCs are talking about setting up a presence here. So I think the whole venture market in the UK will be more international in 5 years from now than it is today.
Well, thank you very much. This has been a really fascinating conversation. Thank you, Ash, Claire, Genghis, and Jeremy for your time today. It's been very interesting. We have had one question, which was just asking if we could make an example of a good pitch deck available. We'll look to see if we can provide some.
That's very difficult.
Yeah, I know.
We can make one up. 10, 20, 30.
We'll see what we can do about that. We don't seem to have any other questions, so I'll just go on to events that I could. First, our website has some examples of how you can develop your company, and particularly I'd like to flag our guide to communicating R&D to investors, which will have some advice for you there. And then on to some future events that are coming up. We have on the 24th of January, first an event on, before that, we've got the JP Morgan webinar. If you are heading to JP Morgan to meet investors, to network over in San Francisco, I'd recommend it. A webinar on the 17th of December. On the 19th, we have a Brexit webinar. We've managed to avoid talking about that today, but if you need to find out what's going on with Brexit, join us on the 19th. And then in January, on the 24th, we have Strategic Technologies in Life Sciences event, where you'll be able to hear from companies that are working in some exciting areas of science in the UK. And then we'll have our gala dinner that evening, which is a great big knees up with 700 people or so in the centre of London. So please do join us for that. And then finally, if you're a young entrepreneur, do take a look at our Pulse workshop program, which we run with the Crick Institute, where you'll get all sorts of good advice for starting and growing your business. So thank you everyone for joining us. Thank you for listening, and have a good day.